Listen, I need you to stop what you're doing right now, because what I'm about to share with you could completely change how you think about your silver position. And I'm not being dramatic here. Something is happening in the silver market that most stackers have absolutely no idea about, and it's going to catch a lot of people off guard in the coming weeks. You see, while everyone's been focused on gold hitting new all-time highs, silver has been quietly setting up for something that we haven't seen in over a decade. And the people who understand what's happening right now are positioning themselves very differently than the average stacker. Very differently. Let me paint you a picture of what's actually going on behind the scenes. Right now, as I'm recording this, the gold to silver ratio is sitting at levels that historically have marked major turning points in the precious metals market. We're talking about a ratio that's been compressed from the 120-to-1 levels we saw during the pandemic panic to something much more reasonable. But here's what nobody's talking about. This compression is happening for reasons that have nothing to do with what happened in 2020. Back in March 2020, when the world shut down, silver got absolutely crushed. It dropped to $12 an ounce while gold was holding strong above $600. That gave us a gold to silver ratio of over 120-to-1, which was the highest it had been in recorded history. And everyone said, this is it, this is the opportunity of a lifetime. And they were right, sort of. Silver did rally from $12 to nearly $30 in just 5 months. But then something interesting happened. It stalled. It couldn't break through that $30 level, and it's been consolidating ever since. Now, most people look at that consolidation, and they think silver is weak. They think it's a failed breakout. They think maybe industrial demand isn't strong enough. Or maybe the paper market manipulation is too powerful. But that's not what's happening at all. What's actually happening is that silver is building the most powerful base it's had since 2010, right before it went from $18 to $49 in less than a year. Let me explain what I mean by that. When you look at the silver chart from 2010 to 2011, you see a very similar pattern to what we're seeing right now. Silver spent months consolidating between $18 and $21, just grinding sideways, frustrating everyone who was holding it. The gold to silver ratio was elevated, sitting around 60-to-1, and people were getting impatient. They were saying the same things they're saying now. Silver is too manipulated. It'll never break out. Just stick with gold. And then something shifted. The fundamentals that had been building beneath the surface suddenly became impossible to ignore. Industrial demand was accelerating. Investment demand was picking up. The supply situation was getting tighter. And most importantly, the paper market structure was setting up for a massive short squeeze. When silver finally broke above $21 in late 2010, it didn't just rally a little bit. It went parabolic. It hit $49 in April 2011, nearly tripling in less than 6 months. Now, I'm not saying we're going to see silver triple in the next 6 months. What I am saying is that the setup we have right now is eerily similar to what we had back then, except the fundamentals are actually much stronger this time around. And that's what most stackers are missing. Let's talk about the supply situation first, because this is where things get really interesting. Global silver mine production peaked back in 2016 at about 900 million ounces per year. Since then, it's been declining. We're now producing around 830 million ounces annually, and that number is expected to keep falling. Why? Because most silver isn't mined as a primary product. About 70% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. And when those base metal prices are weak, or when those mines become less productive, silver production falls with them. But here's the kicker. Demand for silver has been exploding. Industrial demand alone is now over 550 million ounces per year, and it's growing at about 5% annually. Solar panels, electric vehicles, 5G infrastructure, medical applications, water purification systems, all of these technologies require silver, and they're all growing rapidly. The Silver Institute estimates that industrial demand could reach 700 million ounces by 2030. That's a 27% increase from current levels. And that's just industrial demand. We haven't even talked about investment demand yet. In 2023, investment demand for physical silver was around 250 million ounces. That includes coins, bars, and ETF purchases. But what's really interesting is where that demand is coming from. It's not just retail investors like you and me stacking silver eagles and maple leafs. It's institutions, it's family offices, it's sovereign wealth funds. These are the smart money players who typically don't touch silver because it's too small, too volatile, too difficult to store in large quantities. But they're buying now. Why? Because they're looking at the same math we're looking at, and they're realizing that the silver market is about to face a structural deficit that could last for years. When you add up industrial demand, investment demand, and jewelry and silverware demand, you're looking at total demand of around 1.1 billion ounces per year. But remember, we're only producing 830 million ounces from mines. That's a deficit of 270 million ounces annually. Where's that extra silver coming from? It's coming from above-ground stockpiles, from recycling, and from selling by investors who bought at higher prices and are now liquidating. But here's the problem. Those above-ground stockpiles are getting depleted. The COMEX warehouses, which are supposed to be the backbone of the paper-silver market, have seen their registered silver inventories drop by over 60% in the past 3 years. We're talking about a decline from over 150 million ounces to less than 60 million ounces. And that registered silver is what's actually available for delivery if someone stands for delivery on a futures contract. The rest is eligible silver, which means it's stored in COMEX warehouses, but it's not available for delivery unless the owner decides to make it available. Now, why does this matter? Because the paper-silver market trades about 200 times more silver than actually exists in physical form. Every day, billions of dollars worth of silver futures contracts change hands on the COMEX. But only a tiny fraction of those contracts ever result in physical delivery. Most traders are just speculating on price movements and they close out their positions before expiration. But what happens if a large player decides they actually want physical silver and they stand for delivery? What happens if multiple large players do this at the same time? This is exactly what happened in early 2021 during the Reddit silver squeeze attempt. A group of retail investors on Wall Street bets decided they were going to squeeze the silver shorts by buying physical silver and silver futures contracts and standing for delivery. And you know what happened? Silver spiked from $25 to $30 in a matter of days. The premiums on physical silver coins and bars went through the roof. Dealers ran out of inventory. The U.S. Mint had to ration silver eagles, and this was just from retail demand. Imagine what would happen if institutional players started doing the same thing. And there are signs that this is already starting to happen. In the past year, we've seen several large deliveries on the COMEX that have drained significant amounts of silver from the registered category. We've seen the Shanghai Gold Exchange, which also trades silver, experience similar tightness in physical supply. We've seen premiums on physical silver in Asia spike to levels we haven't seen since 2020. The physical market is getting tight, and the paper market is starting to feel the pressure. But let's zoom out for a second and talk about the bigger picture, because this isn't just about supply and demand fundamentals. This is about what's happening in the global monetary system, and this is where things get really interesting for silver stackers. You see, silver has always been money. For thousands of years, silver was the primary medium of exchange for everyday transactions. Gold was for large transactions, for storing wealth, for settling international trade. But silver was what regular people used. It was the people's money. And even though we've been off a silver standard for over a century now, silver still retains that monetary premium in times of crisis. And we are heading into a crisis. Not maybe, not possibly. We are heading into a monetary crisis that's going to make 2008 look like a warm-up act. The U.S. national debt is now over $36 trillion and growing by about $1 trillion every 100 days. The interest payments on that debt are now over $1 trillion per year, which is more than we spend on defense. The Federal Reserve's balance sheet, which was under $1 trillion before 2008, is now over $7 trillion, even after they tried to reduce it through quantitative tightening. And every major central bank in the world is in a similar situation. Now, here's what most people don't understand. This debt can never be repaid. It's mathematically impossible. The only way out is to inflate it away, to devalue the currency so that the debt becomes less burdensome in real terms. And that's exactly what they're going to do. They have no choice. The alternative is default, and default would mean the end of the dollar as the world's reserve currency. So they're going to print, they're going to inflate, and they're going to do it on a scale that makes the pandemic stimulus look like pocket change. And when that happens, when the printing presses really get going, people are going to rush into hard assets. They're going to rush into things that can't be printed, that can't be debased, that have intrinsic value. And yes, they're going to rush into gold, but they're also going to rush into silver. And here's why silver might actually outperform gold in that scenario. Silver is more affordable. It's more accessible. It's easier for the average person to buy. If you're a regular middle-class family and you want to protect your savings from inflation, you're probably not going to go out and buy a 1-ounce gold coin for $2,700. But you might buy a few silver eagles at $35 each. You might buy a 10-ounce silver bar. You might start stacking silver every month as a form of forced savings and inflation protection. And when millions of people start doing that simultaneously, when the investment demand for silver goes from 250 million ounces a year to 400 million or 500 million ounces a year, the market is going to break. There simply isn't enough physical silver available to meet that kind of demand at current prices. Prices will have to rise, and they'll have to rise significantly to ration the available supply and to incentivize more production and recycling. Now, let me address something that I know a lot of silver stackers worry about: manipulation. Is the silver market manipulated? Yes, absolutely. There's no question about it. The big banks have been caught and fined multiple times for spoofing and manipulating the silver futures market. JP Morgan paid nearly $1 billion in fines for precious metals manipulation. But here's what you need to understand. Manipulation can only work when the physical market is loose, when there's plenty of supply available, when the fundamentals are weak. When the physical market gets tight, when demand overwhelms supply, manipulation becomes impossible. The paper market can only suppress prices for so long before the physical market reasserts itself. And we're getting very close to that point. The signs are everywhere. The declining COMEX inventories, the rising premiums in Asia, the increasing industrial demand, the growing investment demand, the structural supply deficit, the monetary crisis that's building in the background. All of these factors are converging, and they're setting up a situation where silver could move very quickly and very dramatically. Now, before we go any further, let me take a quick pause here because I want to mention something that might be relevant to some of you watching this. If you're sitting on $100,000 or more in retirement accounts, 401ks, IRAs, that kind of thing, you might want to check out the free guide I put together on how gold IRAs work. It's in the description below. It covers how you can get physical precious metals into your retirement account without triggering tax penalties or early withdrawal fees. A lot of people don't realize you can do this, but it's actually a pretty straightforward process once you understand the rules. Anyway, if that's relevant to your situation, it's worth a look. The guide is completely free, no strings attached. All right, back to what we were talking about. Let's talk about what this means for you as a silver stacker, because this is where the rubber meets the road. If you've been stacking silver for a while, you've probably been frustrated. You've probably watched gold hit new all-time highs while silver has been stuck in this range. You've probably wondered if you made the right decision. You've probably thought about selling your silver and just buying gold instead. And I'm here to tell you, don't do it. Don't make that mistake. Because what's about to happen is going to reward the patient silver stackers and punish the people who gave up right before the breakout. This is how markets work. They frustrate you. They test your conviction. They make you doubt yourself right before they prove you right. And silver is the ultimate test of patience. But here's the thing. You need to be strategic about how you're stacking. Not all silver is created equal. If you're just buying whatever silver is cheapest, you might be making a mistake. Let me explain what I mean. There are basically 3 categories of silver you can buy: government-minted coins like American Silver Eagles and Canadian Maple Leafs, private mint rounds and bars, and junk silver, old U.S. coins that were minted before 1965 and contain 90% silver. Each of these has pros and cons, and the right choice depends on your goals and your situation. Government-minted coins have the highest premiums, but they're also the most recognizable and the most liquid. When it comes time to sell, you'll have no problem finding a buyer for Silver Eagles. Everyone knows what they are, everyone trusts them, and they command a premium even in the secondary market. The downside is that you're paying a significant premium upfront, sometimes $6 to $8 over spot price per coin. That means silver needs to move up quite a bit before you break even. Private mint rounds and bars have lower premiums, usually $3 to $5 over spot. You're getting more silver for your money, which is great if you're purely focused on accumulating ounces. The downside is that they're less recognizable and less liquid. When you go to sell, you might get offered less than spot price, especially if the dealer doesn't recognize the mint or if the bars are in less than perfect condition. Junk silver is interesting because it has the lowest premiums of all, sometimes just $2 to $3 over spot. And it has the added benefit of being in smaller denominations. A pre-1965 quarter contains about 0.18 ounces of silver, which means it's more practical for small transactions if we ever get to a point where silver is being used as currency again. The downside is that it's less pure than modern silver products, and it's not as aesthetically pleasing if that matters to you. So which should you buy? Honestly, I think you should have a mix of all three. Have some government-minted coins for liquidity and recognition, have some private mint bars for pure ounce accumulation, and have some junk silver for flexibility and lower premiums. Diversify within your silver stack just like you diversify your overall portfolio. But here's what's really important. You need to be buying consistently, not trying to time the market. I see so many stackers who wait for dips, who try to buy only when silver pulls back $1 or $2. And you know what happens? They miss the big moves. They're sitting on the sidelines waiting for a better entry point when silver suddenly jumps $5 in a week, and then they're chasing it at higher prices. The smart way to stack silver is dollar cost averaging. Set a budget. Maybe it's $200 a month, maybe it's $500 a month, whatever you can afford, and buy that amount of silver every single month regardless of price. Some months you'll buy at higher prices. Some months you'll buy at lower prices, but over time you'll average out to a reasonable cost basis. And more importantly, you'll be consistently accumulating ounces, which is what really matters. Because here's the truth. Whether you buy silver at $32 or $34 isn't going to matter much when it's trading at $60 or $80 or $100. What matters is that you're accumulating ounces now, while silver is still relatively cheap, while most people are ignoring it, while the fundamentals are setting up for a major move. And let's talk about where silver could actually go, because I think a lot of stackers don't fully appreciate the upside potential here. Most people look at silver's all-time high of $49 from 2011 and they think, okay, if we get back to $49, that's a good return. And sure, if you're buying at $32, getting to $49 is a 53% gain. That's not bad. But I think that's way too conservative. Let's do some math. If silver just gets back to its historical average gold to silver ratio of 50 to 1 and gold stays where it is around $2,100, that puts silver at $54. But what if gold keeps going up? What if gold goes to $3,000 or $3,500 as many analysts are predicting? At a 50 to 1 ratio, that puts silver at $60 to $70. And that's assuming a normal historical ratio. But what if we get a real squeeze? What if the physical market gets so tight that the ratio compresses to 30 to 1, or even 20 to 1 like it did briefly in 2011? At a 30 to 1 ratio with gold at $3,000, silver would be at $100. At a 20 to 1 ratio, silver would be at $150. Now, I'm not saying that's going to happen. I'm not making predictions. But I am saying that the potential upside in silver is much, much larger than most people realize. And here's something else to consider. Silver is a much smaller market than gold. The total value of all the silver ever mined is estimated at around 1.5 trillion. The total value of all the gold ever mined is around 15 trillion. Silver is 1/10 the size of the gold market. What that means is that it takes much less money flowing into silver to move the price significantly. If just a small fraction of the money that's in gold shifts over to silver, or if just a small fraction of the money that's sitting in cash or bonds decides to buy silver as an inflation hedge, the price impact would be enormous. This is why silver is often called the poor man's gold, but also gold on steroids. It has the same monetary properties as gold, the same inflation protection characteristics, but with much more volatility and much more upside potential. When precious metals are in a bull market, silver typically outperforms gold by a factor of 2 or 3 to 1. We saw this in the 1970s when gold went from $35 to $850, a 24x gain, while silver went from $1.50 to $49, a 33x gain. We saw it again from 2008 to 2011 when gold went from $700 to $1,900, a 2.7x gain, while silver went from $9 to $49, a 5.4x gain. And I believe we're setting up for another one of those moves. The fundamentals are there. The technical setup is there. The macro environment is there. The only thing missing is the catalyst, the spark that ignites the move. And that catalyst could come from anywhere. It could be a major bank failure that triggers a flight to safety. It could be a geopolitical crisis that disrupts supply chains. It could be an inflation scare that sends people rushing into hard assets. It could be a short squeeze on the COMEX that forces prices higher. Or it could just be the slow, steady accumulation of physical silver by investors around the world, finally overwhelming the available supply. But here's what I want you to understand. You don't need to predict the catalyst. You don't need to know exactly when it's going to happen. You just need to be positioned before it happens. Because once it starts, once silver really starts moving, you won't have time to react. The premiums will spike. The dealers will run out of inventory. The delivery times will stretch from days to weeks to months, and you'll be kicking yourself for not buying more when you had the chance. This is why I'm telling you to stop and watch this video. This is why I'm saying this is important, because we are at a critical juncture in the silver market. We are at a point where the patient stackers are going to be rewarded, and the people who ignored silver are going to be left behind. And I don't want you to be one of those people who looks back in a year or two and says, I knew I should have bought more silver when it was in the low 30s. Now, let me address one more thing before we wrap up, because I know some of you are thinking, but what about the risks? What if I'm wrong? What if silver doesn't go up? What if it goes down? And those are valid concerns. No investment is without risk, and silver is certainly no exception. Silver is volatile. It can drop 20% or 30% in a matter of months. It can stay flat for years. It doesn't pay dividends or interest. It costs money to store securely. These are all real drawbacks. But here's how I think about it. Silver is insurance. It's insurance against currency debasement, against inflation, against financial system instability, against geopolitical chaos. And like any insurance, you hope you never need it, but you're glad you have it when you do. The question isn't whether silver is going to make you rich overnight. The question is whether you can afford not to have some exposure to physical silver, given everything that's happening in the world right now. And when I look at the debt levels, the money printing, the geopolitical tensions, the supply chain vulnerabilities, the de-dollarization trend, the BRICS nations moving away from the dollar, the central banks buying gold at record levels, when I look at all of that, I can't imagine not having a significant portion of my wealth in physical precious metals. And within precious metals, I can't imagine not having a substantial allocation to silver given the supply-demand fundamentals and the upside potential. So here's my advice. If you're already stacking silver, keep stacking. Don't get discouraged by the consolidation. Don't get frustrated by the lack of movement. Stay the course. Keep accumulating ounces. And be patient. Your time is coming. If you're not stacking silver yet, or if you've been on the fence, now is the time to start. Don't wait for a pullback that might never come. Don't wait for confirmation that the breakout has started, because by then it'll be too late to get in at good prices. Start small if you need to, but start. Buy a few ounces this month. Buy a few more next month. Build your position gradually and consistently. And most importantly, think long-term. Don't buy silver expecting to flip it for a quick profit in 3 months. Buy it as a long-term store of value, as insurance, as a hedge against the monetary insanity that's unfolding around us. Buy it and hold it. And when the time comes, when silver finally makes its move, you'll be glad you did. Because what's coming in the silver market is going to be historic. It's going to be one of those moves that people talk about for decades, and the people who positioned themselves ahead of time, who had the patience and the conviction to stack silver when everyone else was ignoring it, are going to be the ones who benefit the most. So that's why I'm telling you to stop and watch this. That's why this is urgent. That's why this is important. The setup is there. The fundamentals are there. The opportunity is there. The only question is whether you're going to take advantage of it or whether you're going to look back with regret. The choice is yours.